Hello and welcome, I'm Suyash Maheshwari and you are watching Last Tick here on News9, where we bring to you the lowdown of the day's action on Dalal Street. And it was a bloodbath for the Indian stocks on Tuesday as the market witnessed one of its worst single day crashes in a year that wiped out over 8 lakh crore of investors' wealth in a single session. Nifty at close was down 1.54% to close below the 21,250 mark. Now this was the lowest closing level for the index since December 2023. In percentage terms, however, it was the worst fall for Nifty since January 27, 2023. So pretty much the worst percentage fall for Nifty in essentially a year. Now Sensex on the other hand wiped out about 1067 points to end 1.49% lower, just above the 70,350 mark. This was the lowest closing level for the index since December 13th of 2023. But you know, the bloodbath, I guess, was even worse for the broader markets as they corrected by about 3% in Tuesday's trade. The Nifty Mid-Cap 100, which by the way had scaled a record high early in the morning trade, witnessed one of its biggest single day fall in a month. The index ended about 3.11% lower at 46,569 mark. The small cap index, which also came just in a touching distance away from its lifetime high in the morning trade, fell 2.87%, but still managed to hold above the 15,000 mark. Look at India VIX. At one point India VIX was below 13 level. We were somewhere around the 12.2 mark at the day's low. But as the session ended, India VIX, the volatility index, saw a spike of 7.6% and we closed essentially just below the 15 mark at 14.85 levels. Moving on to the sectors, all sectors, it is a sea of red out there. All sectors barring the pharma pack ended today's trade in the red. Nifty Media was the worst hit among all. It fell about 13% in today's trading session. And that was primarily dragged by Zee Entertainment, which fell over 30% or so after Sony yesterday called off its $10 billion mega merger with the company. And as a reason, other stocks also reacted in the media pack and ended lower. That was followed by Nifty Realty, which fell over 5%, dragged by shares such as Prestige that fell over 10%, and Oberoi Realty, which sank by 9% or so after the Q3, the December quarter net profit tanked by 49%. Among other sectors, Nifty Bank, Nifty Metal, the private banking pack all fell somewhere between 2 to 3%. And we have been talking about how the banking pack on the whole has been dragging the markets lower, and Nifty Bank today again witnessed one of its worst falls in a year. The index has breached all support levels in today's session, and even if you look at the overall breadth of the market, it's heavily favoring the bears right now. Nearly 4 stocks on NSE fell for every 1 stock that gained today. But to understand what happened in today's trading session, let's also bring on board Mr. Rohit Srivastava, founder and market strategist at indiacharts.com. Hi Rohit, thank you for joining us here on News9. Always a pleasure speaking to you. And I want to begin with a very basic question. What happened today? Why did we see a 1.5% crash in the markets today?
So there's a lot of speculation going around. Some of it was actually in the day. I got a news item talking about FII disclosures which have still to be done, and SEBI's been extending the timeline. Now it will reach a breaking point where institutions have to finally either disclose their underlying holdings of who's holding shares to the sub accounts, or else they will have to close their license in India, and that could result in some selling. So that was one of the fears. It could still get dates extended, things could change, but that was one of the things that was doing the rounds. Apart from that, I think if I purely look at the chart setups, it was essentially a very overbought market that has been facing multiple negative divergences. And we've been saying this since December, I think even on your channel, that there are seasonal reasons why January will end up being a top in the market. And we did see a top first in the early part of Jan, then we saw again a run up in the mid, And then now we are seeing a sell-off. And through this period, I don't think Bank Nifty really made a new high. It's just that the Nifty or the mid-cap indices made a new high recently, but the others did not. And so this is sort of a topping process where, one sector peaks first, then the next sector, and the next. And now eventually you'll reach a point where all the sectors which have been diverging eventually fall together, and then you get a panic bottom. So we are not there yet. I think we have just gotten started with the decline phase, because I think today is the first day you've seen mid and small cap indices touch a 52-week high and sell off, whereas Bank Nifty was anyway making lower lows, so that is not new. So I think the broad market, which is where the selling was missing, has started to show up today, which is the mid and small cap stocks. And that I think still needs to get corrected quite a bit. So we are not done. And this should simply be the start of a corrective process that was long overdue.
All right, so you expect the market correction to persist over the next, at least the next few weeks, because as you rightly pointed out, January historically has been a down month for us. In fact, the last 5 Januaries we have ended in the red, and how things are looking right now, this January also the markets are expected to close in the red. We are down about 2.5% or so. You expect a difficult February as well?
I think it can stretch. So like you mentioned, it's actually 7 out of 10 years, in fact, that we've seen down years. And that puts a 70% probability. And usually once you do peak in January, the negativity can stretch all the way into March. So then February also is part of that cycle, 2-3 month phase where, things keep unwinding. There may be short-term rallies. We'll not rule that out. But overall, there would be weakness. In between, you, of course, have the budget event, which will cause its own volatility, whether on the upside or downside, remains to be seen, because the budget event impact is usually based on what the market is doing prior to the budget. So if the markets are usually held up before the budget, sometimes they sell off afterwards because it's like a sell-on news. But right now we are seeing a correction ahead of the event. So if it does keep falling into the event, I would expect the complete opposite, which is sometimes you can actually see a sharp bounce back, post the budget, because, oh, well, there was nothing negative in the budget. And we've seen this picture repeat so many times in the past. I wouldn't expect anything different, especially given that this year's budget is going to be a vote on account. And so that's not going to be much really coming out of it. So let's see. That should be the only short-term room for volatility. But overall, I think between now and March, the trend should be down.
All right, so no pre-election rally as the market was factoring in, Rohit?
No, the pre-election rally only starts later, right? It's usually April, May, because your main elections are May. If you even go back to 2019, there was a correction in March, and then the market rallied all the way from April into May. So
Right.
that is still a future event. That has nothing to do with how the market will do right now. Even if you go back to 2013, the first time the Modi government came to power, in January, it pulled back and then bottomed in Feb and then rallied all the way into March, April. So we'll see the pattern there. There can be a pre-election rally, but will it happen from a higher level or a lower level is something that can be very different.
All right, and I want to specifically talk about the banking pack. I mean, what's going on there? Are we seeing a valuation correction happening in the BFSI segment? Because the numbers, pretty much broadly speaking, are in line with what the street was expecting. But there are certainly concerns around NIMs. But do you think that this pressure around NIMs is likely to persist beyond a few quarters, and could that lead to a prolonged slowdown for the banking sector?
I think, this is in essence been one of the most underperforming parts of the market. Even when the COVID rally started, the first 6 months, the banking sector was underperforming, and then it had a good move. And then subsequent to that, again, we've seen a long underperformance period. So for some reason, even though particular segments of banking have done well, when you look at earnings numbers, you're right to point out that high valuations simply mean that the earnings are catching up with valuations. The question is, can the growth cycle really keep continuing? There are enough reasons long term why that should be the case. But in the short term, I think what is really playing on the mind is sometimes even global factors. So when do we talk of a valuation correction? The reason we talk of a valuation correction is also when the interest rate cycle turns. So we've actually seen interest rates in the US go up a lot in the last year. Now, of course, recently there's a lot of expectation that rates will actually start being cut. But those expectations have not fully, fructified. They've not really become real. And if they've not become real, then is something really going to change on that front? I think it's too early to say that rates come down because one thing is talking about cutting interest rates. The other thing is if we simply look at bond yields, they've started to tick up a little bit in the last week or two. So the valuation correction we saw in 2022, we saw a lot of that recover in 23 because of liquidity. But are we due for the valuation correction theme to actually come back? I think to some extent, the answer is yes.
All right. But apart from what happened today, what transpired in the markets today, India achieved significant milestones as our market surpassed Hong Kong to become the world's fourth largest stock market. And it's not just us who has done well, to achieve this feat. Hong Kong's market and Chinese market also has been struggling since hitting a peak in 2021. So purely from a valuation standpoint, can we maintain this lead? Because the consensus view is that the Chinese and the Hong Kong stocks are looking cheap, whereas we are looking a little stretched at this point.
So that's been true for various parts of the world. So if you actually look at Hong Kong, it's been in a 3 to 4 year bear market. So it's not that it's only falling this year. The last time it was at an all-time high was years ago. So Hong Kong has been in a slow decline. China has not made it back to the highs like the US. The other parts of the world that have been cheap are actually Europe, because if you simply look back, a year ago, the P/E ratio on the DAX or the FTSE were in single digits or close to 10, 11, near the single digit range. So they were actually very, very cheap compared to our market. But then the attraction of the Indian market has been the growth story, right? None of them are seeing GDP growing at 7, 8%, whereas we are. So there's clearly a reason why we have a valuation premium. We cannot deny that part. The only thing is that when the global growth actually starts slowing down, then it has a downward impact across the world, and that is the risk that we really face. It's more global than domestic.
All right, and China, as we speak, is also reportedly working on a 2 trillion yuan, which equates to about $280 billion stimulus package. Could that provide that fillip that has been lacking for the last 2 years?
So we've seen many announcements, from China around this coming stimulus, and it has not shown up yet. They've cut risk interest rates multiple times, and that has not helped. So I'm not sure whether $280 billion does the job or doesn't do the job, given the size of problem that they're actually facing in terms of their real estate market. So slightly hard to judge. I cannot say I'm an expert on China, but
Right.
if I simply look at their charts, it doesn't give me comfort. And let's say that China does manage to reduce the downward pressure that is there from its front right now. Most markets have anyway been ignoring what is happening in China for whatever reason. The US market just made an all-time high or a 52-week high on the Nasdaq on Friday. So it's as close as that. And the real issue then there is, will the US economy see a slowdown, because they've been in the environment of an inverted yield curve for quite a while, which is a signal that a potential recession could be around the corner, and they are not pricing it in. So you have a lot of these divergences, one where China is slowing down and its market is down, whereas US, which is slowing down and its market is up. Now, which one is really going to, catch up with whom is the really $1 million question, right?
All right, and if you see the chart that our producers are playing, Japan holds a third spot. There's a $2 trillion valuation difference between us and them. When do you think can we overtake them? Because again, Japanese stocks have been long undervalued and they have only started performing in the last year or so, whereas we have been on an 8-year bull run, which is, by the way, is also unprecedented.
Yeah, so one of the reasons, I mean, apart from Japan trying to or attempting to show growth, it is a highly linked market to global growth. So it's not possible that global growth slows and the Japanese market continues to run. But the reason it is running, if you really understand it closely, is that they are allowing their currency to weaken. In fact, when QE was switching to QT, 2 years ago, when the Federal Reserve was talking about raising rates, and then they went back to switching from QE to quantitative tightening, Europe was the next one, waited almost 6 to 8 months to switch, and Japan was the last. They didn't even want to do it. What that meant is that they pushed the Japanese yen from a 140 to the dollar all the way to a much, much higher level. And now that the Japanese yen is at that level, uh, it's still weakening. I mean, it did strengthen for a bit in between, but it has started to weaken again. So main point being that weakening your currency has been the game, right? That has been the game. US weakens its dollar, the whole world benefits. Japan weakens its dollar, Japanese benefit. So if we really have to catch up with Japan, what are we going to do? Are we going to weaken the rupee? That is then the question with the Reserve Bank of India.
All right. That's the view coming in from Rohit Srivastava. Sir, always great insights from you. Thank you for joining us and giving us your time here on News9.
Pleasure. Thank you.
But with that, it's a wrap on this edition of Last Tick. But stay tuned with us as we'll be right back with Business Plus.
तो जब हम करेंगे तो पता लग ही जाएगा. सलमान खान का करेंगे, मारेंगे ही जाएंगे. जोधपुर में मारेंगे तो पता लग जाएगा.
This is someone who is sitting inside our jails and is still very obviously